Hi folks, and welcome to the Financial Argument Channel. Today's episode is Stock Market Crash 2020, warning bells are ringing, the stock market bubble will pop soon. Before I start, I'd like to ask whether any of you remember the dot-com bubble. Some of you probably aren't old enough to remember since the bubble peaked in 2000, but I'm sure the rest of you recall what happened that year. There's a reason I mentioned the dot-com bubble and the year 2000. Almost 1 week ago, the Nasdaq 100 index started increasing and gained almost 2%, setting a new record high. Then on the same day, it lost the 2% plus a little extra. This weird and unexpected situation has only happened one other time. March 7th, 2000. The date the dot-com bubble reached its peak. Things are becoming clearer every single day. Today's stock market bubble will burst soon. Let's begin. The Wilshire 5000 to GDP ratio, also called the Buffett indicator, is an important tool for analyzing the current market position. It's calculated by dividing all the stocks in the U.S. by the country's gross domestic product. This chart helps us make a clearer valuation. It's crucial to determine whether or not there's a bubble in order to understand the price levels, which might reflect the real value or an inflated one. Don't forget, the global capitalist economy creates bubbles, and the dance will continue as long as the system does. Anyway, by analyzing this chart, we can estimate the current situation and prospective collapse. Additionally, in the chart, we see recovery starting from March 2020, which, as I've told you before, is completely an illusion. This so-called recovery is a mirage caused by governments printing money. Governments have used the same tactics before, and the illusion will disappear very soon, so be prepared. The Wilshire 5000 to GDP ratio also allows us to estimate the total market cap. Don't forget that the ratio hit a historic high, 155%, right before the collapse in March 2020. Therefore, this current illusionary recovery is really a perilous signal for the stock market. For those of you who watched my previous stock market crash video that had to be deleted for some reason, you may remember that I said the rookies were investing all their pocket money in the stock market and falling prey to market sharks. Think about it. The company run by economic guru Warren Buffett is holding on to a massive amount of cash. According to Business Insider, Warren Buffett's Berkshire has a record $137 billion cash pile. Unbelievable, right? You may also remember that Buffett sold many of his shares and to position himself with cash to be ready for any new shock to the markets. This is where we are at the moment. This also means that many other investors around the world are ready and waiting with cash to attack in the right place at the right time. Meanwhile, the Union Bank of Switzerland, widely known as UBS, has recently made a statement regarding rich families and their investments. This statement is crucial, as UBS is one of the top banks in the sector. UBS stated that almost 120 very rich families took out bank loans to invest in stocks right in the middle of March 2020 when global stocks jointly plummeted. Today, the same rich families have started selling their positions in the financial markets because they've already made enormous profits. Now is the time to sell, according to the big sharks. Joseph Stadler, who made a speech on behalf of UBS, told the press that their Asian clients in particular have started selling and they're expecting more to come towards the end of 2020. The threat is obvious. The sharks are selling, but rookies are buying. The rich become richer while the poor become poor and homeless because they can't pay their debts. Instead, they're investing in the stock market with all the money they just got from their governments. By the way, July will probably be the last month of governmental paychecks given to U.S. citizens, and no one knows what those people will do in the future when they don't have a penny in their pockets. Let's talk about the real sector instead of the corrupt financial system. This chart shows consumer foot traffic in the United States. 100 is the starting point, so anything below 100 means consumer traffic has decreased, and anything above 100 means it has increased. Also, different lines show different categories as noted on the chart. First of all, we see a plunge in the chart in March, which was the sudden collapse of the global economy. The chart shows that casual dining and mall traffic dropped to near zero from 100. After March 2020, consumer traffic has increased little by little, but it hasn't reached the level it was at before March 2020. Then, right after the middle of June 2020, we again see a decrease in the chart. Sure, you might say, well, people were at home, that's normal. But look at the data for non-store retailers from June 2020. There's also a decrease of 2.4%. The same is true for retail sales in general. In the chart, we see a sudden stop in retail sales around March to April 2020 after governments around the world deployed various financial tools. We start to see an uptick. At the same time, though, I don't think it'll go back to the levels it was at before. Another chart is the Consumer Sentiment Index. The plunge is plain to see. It's obvious. While consumers seem to start feeling more positive around May, consumer sentiment suddenly started falling again in early June. This data is all correlated with each other and especially with financial engineering. The most important tool in the financial markets, as I've stated several times in my previous videos, is money printing. When I say money, I primarily mean the US dollar, of course, as 60% of global trade is conducted using it. Therefore, the Federal Reserve's every action should be monitored very closely in order to better estimate our financial circumstances from a macroeconomic perspective. Please take a look at the chart, which shows central banks' balance sheets compared to their GDP. If you look closely, you'll notice that most banks aren't on the chart. Only the Bank of Japan, the Federal Reserve, the European Central Bank, the Swiss National Bank, and the Bank of England can be found. This is because they control reserve currencies, and not all currencies are reserve. These 5 reserve currencies' balance sheet to GDP ratios are significant in that all of the reserve currencies are being printed by the central banks. The previous charts I've shown you are very simple illustrations of what's going on and what's going to happen in the very near future. While the Fed was printing money, stocks rose. Now that it has stopped, we've seen a halt in the stock market as well. Several weeks ago, investors were acting as though everything was normal. It's clear they don't remember what we've seen happen in these situations in the past. Sharks took out loans and entered the market before anybody else did. Now they're selling their position without hesitation. Robinhood and other rookie investors are now stuck between the idea of selling or investing more as stock prices have halted, and they are not that experienced. IMF and Fed officials have also warned the market as cutting spending too soon could damage the recovery. Additionally, Randall Quarles, a high-level executive at the Fed, also stated that world markets might flip messy. In the meantime, political tensions are rising. On July 23, 2020, the U.S. ordered China to close its consulate in Houston by Friday, according to the Washington Post. The short deadline given to Chinese officials was not in accordance with international customs, and U.S. diplomatic missions in China are waiting for a response from the Chinese government that may include the order to close one or more U.S. consulates in China. All of us know that U.S.-Chinese relations are really troubled right now, and the very short amount of time U.S. officials gave for the order to close the consulate led to Chinese officials burning all their documents. There's been so much negative news about the economy, yet investors have disregarded all of it. On top of that, now we're going to have to deal with significant political tensions like we haven't seen in decades. Once again, the struggle will be between the 2 most powerful nations in the world. This time it's happening while we're on the edge of a new great economic collapse. All in all, I think things are going to get even worse. In addition to the faltering global economy, it's likely that geopolitics, particularly involving China and/or Russia, will play a role throughout the November elections and beyond. This will have a significant and detrimental impact on the situation. There are warning signs of stock market crash on the horizon. Be prepared, folks. Don't fall for the illusion of monetary tools. Think of yourselves, your future, and your family. They're what we live for. Please share this video with your loved ones to help them understand the looming collapse of the stock market bubble. As always, thank you for watching. We'll see you in the next video.